Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, and here we have it about 3 minutes before the close of the markets. We're looking at the daily candle chart of the Dow Jones Industrial Average ETF, and as you can see here, we're still at this resistance high up here with a drop in volume on the way up. As I zoom into that volume, you'll see that we have 4 consecutive green candles on the volume bars. Today's volume as we close the market on this Friday, July 25th, that volume is about 30% less than what we saw from yesterday. Down below, you can see the CCI, even though the markets are up slightly today, you can see the CCI is still going down. So I still have my downside target set down here. I'm going to get to that in a moment to show you what we've been experiencing this year, or at least over the last 12 months. So these diagonal lines represent my targets. That downside target on DIA is 437.64. As we move into IWM, this is the Russell 2000 ETF, you can see that we are pivoting lower here. And while the price was hitting this high right here from the 23rd, yesterday we saw, again, another drop in volume. Now look at that moving average. You can see that the price from today's low is right above that 20-period moving average. So the moving average is still holding as support. But if I back out, you'll see that the fan lines are going more and more vertical. I talked about this during some of our webinars this week. And don't forget to catch next Tuesday's Technical Tuesday educational video, because I'll be showing everyone how to draw these fan lines. When you get 3 or more fan lines, which are basically an acceleration in the trend, here we're at the 3rd and most vertical fan line. The more vertical you go, the greater the chance the markets are going to drop. So if I go back to that daily chart, you'll see that not only is the market holding the trend line and that moving average, but if we get a breakout below that fan line, there's now an 80% chance that the price will drop to the next fan line in the sequence of fan lines. And again, I'll be digging more into that on Tuesday. This is a concept with regard to fan lines that I've been tracking for over 4 decades. And I can show you the evidence on how that's true. The more vertical the fan line, and there we have it. The markets are officially closed. That's the 4 o'clock closing bell. Going back to the fan lines here, I've been tracking that for 40 years. And what happens is prices cannot sustain vertical growth. Now, this is not as vertical as what we're seeing in some of the AI stocks and even some of the crypto stocks, but it's still an overbought condition. The Shiller PE ratio is the second highest level we've seen in the history of the markets. I'll talk more about that next week. And as I discussed last week with the Buffett indicator, that's the highest reading we've ever had. So no doubt the markets are overextended. And what I talked about with our members yesterday on the equity call, I used an analogy of walking out onto thin ice. Now, I took the liberty of putting together a little picture for you on AI to give you the full impact of what I'm talking about here. But imagine the FOMO trader out there walking on this thin ice that we're labeling the overvalued market in an attempt to chase profits. Now, this FOMO trader may not be too concerned about the ice breaking under his feet because he's so focused on taking those profits. But what I'm looking to do for our members and viewers, especially on YouTube, is I'm representing this rope, okay? And I'm trying to help people at least focus on managing risk. There is nothing wrong with taking new long positions, but being concerned and even being protective of a pullback in the market that could be significant. Because what happens is, if you have stop orders in place and the markets do go down, guess what those stop orders do for you? They help generate more buying power because you're moving out of stocks that are now dropping, and it's building your cash reserves so that when the markets find the next low, you'll be ready to go with a war chest of money to be buying into that market at the new low. And I'd rather be more defensive with my long-term outlook than to be overly optimistic and not have any risk management in place. And that's basically the common sense approach that we're taking to this market. As I've said before, the majority of our positions that we've taken this year have been bullish. The overwhelming majority have been bullish, and we've been doing extremely well. But every single time I go to the comments, I shake my head and I think, what is this person looking at in our videos that they're not getting my message that we're still able to take long positions, but my long-term outlook is extremely bearish. Looking at the Qs, you can see that we are riding that moving average. I did say last week because of the increase in volume that we would most likely go a little bit higher, and I was looking for a drop in volume. You see, that's why I drew that horizontal line there. Now, we finally got this drop in volume to the level that I was expecting. And now that we see the drop in volume, what's happening to the CCI on the Qs here? That is starting to hinge. You see, and not only do we have a higher price high here today, but we have lower highs on that CCI, and that's the negative divergence that I've defined and continue to talk about. So there's the rope, right? There's the common sense that tells us the markets are still moving higher. We can see that with our own eyes, but the signals are telling us that the ice is starting to crack. So we have to do something to protect ourselves. Now, I promote the 1% rule for managing risk quite heavily. Each and every trade publication that I put out to our members includes the idea and the concept of risk management using a simple calculation that we call the 1% rule. Go to our website. You can sign up for a 15-day free trial, no strings attached. Learn about how to manage risk. Learn about the 1% rule. Learn how to follow the 7-point trading checklist. And you could do very well in this market, navigating even in an overextended market. So I'm still keeping my downside target in place right here at 546.15. Looking at SPY, this is the S&P 500 ETF. Also, we did not see the drop in volume last week, so I'm not surprised to see the higher prices. But you can see here, my downside target for the short term is still 615.26. Looking at the monthly on the SPY, look at what we're talking about here. You see this vertical price move. This is a monthly stretch of green. We have 3 green months in a row. But again, we only have a few trading days left in this month. There's no way this month's volume is going to beat last month's volume. And the markets are already overextended on the CCI and the stochastic. Remember, if you're brand new to these oscillators down here, you have to understand that on a scale from 0 to 100, when the stochastic, which is the blue line, goes over 80, which it is, by definition, that is overbought. Now, for the CCI, I'll repeat this for those that are brand new to the CCI, my favorite indicator of all time. When it goes over 100, which is that red line, it is now overbought. And when the CCI starts pivoting lower and crosses back below the 100 line, that's when the sell signal takes place. So the markets are still pushing those highs, but the volume is dropping. We see the wide divergence from the moving average on the monthly. We're seeing it even more so in the daily chart here. You see the wide divergence from that moving average while the CCI is still going lower. So for SPY, downside target 615.26. I'm going to talk about the VIX. I'm going to talk about the Bitcoin market, and I'm also going to show you our track record for the last 12 months, which I think is going to surprise you. It did surprise me as well. All right, so the VIX still pressing those lows, new lows on the VIX, but look at that CCI. Isn't that interesting? While the VIX is going lower, the CCI is starting to turn up. That is not a common occurrence. In fact, it's very rare that we see that. So I still have my upside target on the VIX right here for the short-term traders to trade the VIX at 1948. So you're talking about almost 4.5 points to the upside on roughly a 15-point price close on the VIX. All right, so a bullish VIX, especially when it starts to show the buy signals, is bearish for the S&P. Keep that in mind. Now looking at Bitcoin, which is /BTC on the Thinkorswim platform, we have this sideways channel. It looks like Bitcoin right now cannot get out of its way. Now, there's a lot going on in this chart that you need to know about, so let me explain this to you. First and foremost, we have a bearish harami, which is a small-bodied red candle that falls within the green. Let me show you what that looks like. And then what happens is we have a bullish harami that follows the bearish harami, which is bullish, obviously. That's in the title of that pattern, which now is followed today by a bearish engulfing, which is the most bearish of all of those patterns. Now, what confuses a lot of folks is because while the candles are looking bearish, especially after the close today, this could be interpreted as a flag pattern. Now, I talked about that on my last video. If it breaks out of that flag, that could be considered a bull flag. Bitcoin actually could run in the length of the flagpole. So that would mean another 20,000 points to the upside if we get a breakout supported by higher volume. You have to see the higher volume come in. So beware of that flag, because here's the other part of that. If it doesn't break out to the upside, but instead goes to the downside, a failed breakout of a bull flag results in a pretty severe sell-off. So we're at a turning point, or at least a critical point for Bitcoin. Goes up, it could go up big. If it goes down, obviously it could go down big. And it sounds like I'm speaking with a forked tongue, doesn't it? But when you take a step back and you look at the weekly, that convinces me that there's more bearish signals showing up on the weekly, because that's a shooting star from last week. And this week, we have a lower high, low, low. So there's your pivot, and the CCI and the stochastic are already heading down. So for you Bitcoin traders out there, I would say protect your profit. Remember the rope representing your stop losses. Okay, that's going to protect you. If you start falling through the ice, your stop losses will save you. All right, so enough of the fun. We're having too much fun here today. I want to give you some of the economic news and political news and what's happening, starting with the Fed. You may have caught this already in some of the headlines. Trump has his sights set on Powell. Now, there was a lot of rumor going around earlier that Powell was going to resign. I think he's dug his heels in deep, and I think what we're going to see next is we're going to see Powell come before Congress, or we're going to see the Department of Justice knocking on his door. Go to my X page, and you could see a post that shows a video, and I would say it's a very embarrassing video. It's almost like a comedy show where Trump and Powell are walking through the construction area of the Fed with their white hard hats on. And it's kind of ridiculous with the silly hard hats. But Powell obviously looks very nervous when Trump hands him the documentation about the overspending, and how it's now being uncovered that Powell, not only is he accused of lying under oath, but it looks like he actually did commit perjury. So what's the next steps here? Well, it looks as though Powell will be in this very tough position, and they talk about how Powell's going to serve out his term, but I don't know about that, because it's not just Powell that is under fire. It's the entire Federal Reserve. You may have caught some of what Thomas Massey has introduced. This came out originally in March, but he's reintroduced a bill to abolish the Fed. You could just look at some of these headlines here and Google search for the content. Now, this is a big deal with regard to the Fed, because there have been attempts in the past to end the Fed. Go back into the 60s and you'll read a little bit about what JFK and his brother Robert, the Attorney General at the time, you got to go back in history and understand what's happened. They were totally against the Fed. They were trying to abolish the Fed. And as history shows, they were obviously not successful. And if you want, you can go to congress.gov. You could read more about the House Resolution 1846, Federal Reserve Board Abolition Act. This is coming out. It has been introduced. It will eventually be voted upon. If it passes the House, it goes to the Senate. If it passes the Senate, it goes to the President, becomes law, and the Federal Reserve is history. And Powell will go down as the last Federal Reserve chairman. Now, while some people think this is a far stretch that'll never happen, each and every time it moves forward, it looks like it's gaining some roots. And it's going to be extremely interesting to see how this all plays out. One of the big deals and why Congress was even questioning Powell with regard to the spending and the renovations at the Fed, is that taxpayer dollars are going to renovate buildings that are not government buildings. The Federal Reserve is not a government agency. They're a private entity that controls our money. And Trump is looking to abolish that, along with many representatives in the House. And I think if you read into this story and look further into the digital aspects of what we're talking about, I think this could more or less launch the digital era for our currency. And I'm not going to go too far into that right now, but if you stay tuned to our live broadcasts on Wednesdays, eventually we're going to have some cryptocurrency experts come on where we can question them and get their views on where they think Bitcoin and the digital push is going. Now, let's get to one of the main points of today's presentation. Like I said before, when I pull up the charts, especially like DIA, I'm going to show you something going back as far as I can for this year. You see these diagonal lines that I've drawn. These are the projected target lines that I draw every now and then on these weekly market reports. And if I go back all the way to the beginning of this 12-month period, you could see that we have some lines that are moving down in red, and then we have them moving up in green. These are what I call two-part forecasts. And you could see here, obviously, when I put this forecast out, the market did move down, it hit that target, and then it bounced right up and hit my upside target. Now, I don't know of any other analyst that's going to give you two-part forecasts like this. But please understand, I do not cater to long-term investors. I cater to swing traders, particularly option traders. Now, as we progress, you could obviously see here's a downside target that was eventually hit. You'll see over here, it definitely hit back here. And I progress, and here's another upside target, downside target, two-parter. Here's another two-parter, upside, downside. As I back out, you could see that while some of these targets hit right away, other targets took a while to hit. And a lot of times we'll see that once my targets hit, like it did back here, it took a while, but the market will then bounce many times because when I'm drawing my targets, I generally look for support levels where if the prices hit my targets and even go a little bit further to hit these support levels, there's a good chance that the support levels will hold and the prices will bounce. But as we progress through this chart right here, you can see that all of these targets have been reached, every single one except for two. Now, this is the most recent target that I still have in place. This is a longer term target that the trolls seem to be focused on. And I do. I get a little bit of a chuckle. But at the same time, I'm very competitive. And I told my members this. I coached lacrosse for 20 years. So I like to win. And I also like to document the success along the way. I don't just put a target out there and then just forget about it. I keep track of it. I monitor it. I record it. And then I report on it as well, as you all know. But here is the official record, and this is what surprised me because overall, the analysis that I do on thousands of stocks over the course of time, our average hit rate is 82.2% on individual ticker symbols. And I never went back to check the percentage of the hit rate on the general market or the major market ETFs. So I took some time, a lot of time actually, and I went back to each recording and I documented the targets and whether or not those targets hit or whether or not they're still open. And obviously you can see here from this spreadsheet that out of 23 targets that were set over the last 12 months, 21 of them have hit, and there's only 2 that are still left open. So with that success, right now on DIA, we have a 91.3% hit rate. Now, please understand, that's not a declaration of income or percentage of return. It's simply a report on the hit rate. So 91.3% is phenomenal. All credit given to the charts and the technical signals that we look at. Now, if the most recent target hits in what I just mentioned on the chart, then that's going to be over a 95% hit rate. And of course, if the target all the way down at the bottom that I represented, that all the trolls are looking at, then it'll be 100% hit rate. And I do believe that that target way down here at 368.12 will eventually hit. It's going to take some time, but I think it absolutely could hit. And that point, we'll have 100% hit rate. But I went back even further and I looked at all the other markets. IWM had 23 hits out of 25 for a 92% hit rate. The Qs were a little bit less and right on par with the diamonds at 91.3. The SPY was 89.4%, a little bit lower than DIA, IWM, and Qs. Obviously, you could see the percentages there. But what surprised me was the VIX. I thought that would be the higher one. Again, I had not gone back to check that. The VIX had the lowest at 87.5%. Folks, you could make money being right 60% of the time, even 55% of the time if you manage risk correctly. Now, what our marketing team is going to do is they're going to redesign this spreadsheet, put it on our website so that the dates that you see in this column here will be hyperlinked to each one of the individual reports that went out on that day. So in other words, if you're a member, you could go back, click on that date. It'll bring you to the YouTube video that went out that showed and talked about the target that I set for 392.18. And what's good about that with regard to learning the signals, you could go back to that day to see the signals that I was looking at that time that gives us such a high percentage for the hit rate. So I'm very excited about this. Again, it did surprise me. I thought maybe it would be on average, maybe in the mid 80s. I did not expect it to be in the low 90s, and it could even go higher from here. So if you follow the 7-point trading checklist and you follow the signals and you learn the patterns like we teach here at StickyTrades, then you will eventually build your own ability to read these charts and forecast your own price targets on your own. And I tell our members that when you're going through this process of learning, you should be shooting for at least 70% hit rate. So if you want to give yourself an assignment during the course of the week, go look at 10 or 20 charts during the course of the day or maybe even the week. Put your own spreadsheet together, put your own diagonal lines on the chart like I do here, and then go back and track your percentage of accuracy. You don't have to put any money into the market to practice this. And then once you get to 70% and your skill level is good enough to be able to forecast with great accuracy, then you could tiptoe into the market, step onto that thin ice if you want to, and still be able to read the signals so that you'll be able to protect yourself and manage risk. Folks, I can't tell you how much fun it is for me to be able to put these videos out for you. I hope you're enjoying them as much as I do. Remember, you can come to StickyTrades, free membership. There's no strings attached. You don't have to give us your credit card or anything like that. Just come on over for 2 weeks. You're not obligated for anything. After 2 weeks, it just fades away. If you want to come back, that's fine. But we don't hound you. We don't call you. We don't pressure sell you. We don't do any of that. We want to build a relationship with our audience. Speaking of which, please remember to hit the subscribe button and the bell, because we noticed that last week during the live webinar, for some odd reason, Facebook did not broadcast the live session. So if you click on the bell at the top, you'll get a notification on your smartphone right before the live broadcast goes on air, and then you could catch us and not miss a thing. Remember, the live event on Wednesday is interactive. So you could type in some ticker symbols. You could ask us questions. You'll be able to interact with us. It's a very fast half hour. We don't go on very long, but it is also recorded, and you could go onto our YouTube page to pick that one up. So thank you so much. Have a great weekend, and I'll talk to you next week. So long.
In a world of endless data, where every second counts, introducing Nod Live, your professional compass in the chaos of the stock market. Nod Live cuts through the noise. Stay ahead with Nod Live.